This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. The particulars contained herewithin were obtained from sources we believe to be reliable but are not guaranteed by us and may be incomplete. The opinions expressed are based upon our analysis and interpretation of these particulars and are not to be construed as solicitation or offer to buy or sell the securities mentioned herein. The opinions expressed do not necessarily reflect those of National Bank Financial.
Alrighty, welcome. It is January 8th, 2026.
Welcome.
Happy New Year to everyone.
Happy New Year. Hard to believe it's a new year.
I know, and a crazy start right off the bat.
Right off the bat.
Right off the bat.
Just like last year.
January 2nd, wake up. You see the news?
Yeah.
Well, we got a lot to unpack today. Appreciate everybody taking the time to view this. It's going to be, I would say, we thought we could keep it down to a minimum today, but unfortunately, New Year outlook, there's still a lot of things for us to get through today, a lot to unpack, a lot of noise, and obviously we want to make sure that you guys understand what's going on both in the markets, the economies, and how that overall relates to what our positioning is going to be heading into 2026.
Yeah.
Interesting.
We've got the black and white thing going on. Don't you? Don't you think it would be a lot easier on everybody if the markets were just black and white?
Yeah,
it would
just
be. Just kind of figure this thing out. So
I wish they were.
Yeah. Well, we dressed appropriately for it.
We definitely did.
Let's just dive into everything and just to go back and look at the forecasting. And I've never seen a period in 41 years of managing money that forecasting has been this challenging. Trying to figure out where this thing, it would be great if it was black and white, but we just have absolutely, to be honest with you, no clue what's going to happen. You take a look at the forecasting in 2024 from all the top banks and analysts, and, they missed the boat.
Yeah, because everybody was
badly, extremely bearish.
Extremely bearish.
Yeah. And then you flip to last year, and they had a much better year. They only missed the mark by like 2.5%. And I remember thinking to myself a year ago, when there wasn't a firm on Wall Street or Bay Street that thought that the markets could end up in negative territory, not one analyst. Yeah. And I'm kind of thinking, wow, that's pretty lopsided, everybody. But as it turned out, we had a third year of double-digit returns. So can you tell me what's going to happen in the fourth year? But what surprised me about the year, and if sitting here a year ago, I thought there would have been more volatility. I thought we were going to get a deeper correction.
April wasn't enough for you?
Well, what's interesting about the April, I
would say that's a lot of volatility.
Yeah, but what the point of the volatility is that's April 2nd to April 8th. Yeah. Those are the dates. But there's only 5 trading days in there. Yeah. 5 trading days, and the market drops 12%, more than a correction of 10% in 5 trading days.
Remember it vividly.
Yeah, so I would have thought that it wouldn't have rebounded as quickly as it did. And then you take a look at the VIX, the volatility. The VIX is like at 15.5. There's virtually no volatility. Investors have this high degree of confidence. You take a look at the 5-year average of the VIX, you're at 20 to 22, and now we're at 15. You take a look at the little hiccup, right here, and that was in November. That was a 4.5% drawdown in like 3 days. But the reality is, once we went through that little downward blip, it was kind of clear sailing, which surprised me for sure. So when we take a look at the backdrop right now, and you take a look at the vital statistics, the backdrop looks pretty decent for the stock market. If you take a look at inflation, at 2.7% in the U.S., 2.2% in Canada. But if we go back to June of 2022, middle of COVID, inflation peaked in June of 2022 in the United States at 9.1% and 6.8% in Canada. So you see where we are today. That's a significant decline in inflation, which is obviously good for the stock market. You see GDP, gross domestic product. I mean, the U.S. had a brilliant third quarter, 2025, fastest growth in 2 years at 4.3. And then you move over to Canada and you look at, where's the growth?
Yeah.
Consumer
spending was actually negative that quarter.
Yeah, it's actually a tale of two different markets.
Yeah.
And, you know, you take a look at the bank rates, and I think that's what's important. The bank rates peaked in July of 2023. The U.S. peaked at 5.25 to 5.5. Canada peaked at 5. So you can see rates have come down more in Canada, obviously because of the low GDP growth. And you can see that, you know, the Feds dropped again on December 10th. Yep. The market this year is pricing in 2 Fed cuts in the States. Canada will probably be on hold. But we have to remember that Jeremy Powell's term ends May 15th. Mm-hmm. The lead runner is a man by the name of Kevin Hassett. Yep. And he's been a long-time Trump economic advisor. So, needless to say, whoever Trump appoints as the head of the Federal Reserve will give him back a little carrot, and that'll be another quarter-point drop. So whether we get 2 or 3, you know, yet to be seen.
Yeah.
So that'll be interesting. But, you know, I mean, Trump only has to wait till May 15th. He's been, you know, attacking Jeremy Powell in the press and wants him gone. So that's just around the corner. Take a look at the unemployment figures. I mean, 4.6, that's been the level in the U.S. for the last couple years. Canada peaked in August and September of last year at 7.1, and we're at 6.5 right now. But when you look at that in totality, not a bad backdrop.
Yeah, it's not a bad backdrop. And we went through this at the luncheon too.
Yeah.
We went through all the inflationary story, told you that inflation in the United States is going to run a little bit elevated. We're not getting back to that, like you said, 9.1%.
Yeah, we're not.
Peak of 2022. Yeah, but we are going to run a little bit higher than what was the post-Great Financial Crisis, where we had rock bottom rates for a while, with 2% inflation. Those days are gone.
Those days are gone, and we've got a chart coming up on that inflation. But a lot of the story for 2025 was, you know, bad news is perceived as good news, and good news is perceived as bad news. So, you know, you get a strong, you know, employment number, you know, and the market goes, okay, so, you know, market goes, well, you know, employment's actually gone down. That's a good thing, but then all of a sudden the market reacts and goes, no, it's actually bad news because there might not be
as many interest rate cuts.
Cuts. You get a strong GDP growth number like we saw in the States, right? Like, how can that be not good news? Not be good news, but it's perceived as bad news because it means there's going to be.
It's all about liquidity.
It's all about liquidity, and it means that there's probability of less rate cuts. So I think that was a lot of the compelling story. This chart, I got to spend a couple minutes on it because I find it absolutely mind-boggling. If you look on the far left, and you take it, and yes, this chart only goes out to the end of September of 2025, but extrapolate forward, and the numbers aren't going to really change that much. But I find it absolutely mind-boggling that companies that make absolutely no revenue whatsoever had a price return last year of 34%. 34%, no revenues. Hope.
That's what you call a company with no quality.
Yeah. But that is hope, momentum,
and
speculation, greed, herd mentality.
Yeah. There's a lot of factors.
There's a lot of factors because, honestly, that makes no sense. If we look at the Mag 7, okay, profits through the roof and virtually half of non-revenue. Yeah. I mean, take a look at the profitable.
But the Mag 7 too. That's basically Google and Tesla.
Yeah.
Amazon went nowhere. Some of the other ones, Meta.
Yeah, Amazon profits weren't that bad, but the other stock appreciation,
regardless,
wasn't that great. But you take a look at profitable NASDAQ companies, a 7% price return. Yeah. And then the broader market. And we're got to talk about the broader market and quality companies. But if you strip out the Mag 7 last year, 493 companies, a mere rate of return of 8%. So I can't tell you exactly what's going to go on this year because honestly, I don't have a clue. But I can tell you at some point in the time, the pendulum is going to swing from the no revenues to the revenues. And I think that's
agreed.
Only a matter of time. And the amount of spending, I mean, you look Microsoft, Meta, Amazon, Google, and you take a look at these giant gargantuan, AI mega plants. I mean, the amount of money that is projected to be spent out to 2029, $3 trillion. So the race is on. It's almost like FOMO for these companies, right? The fear of missing out.
It's the AI arms race.
Yeah. And the interesting thing about this is that and what Michael Burry has, publicly stated and what he's worried about is the servers, the life of these servers back in 2020, they depreciated it over like a 3 to under 3 year period. Now they're saying it has a shelf to 6 years. Yeah. So what that does, obviously, it spreads out the cost and it keeps the profits higher, in the shorter term. But I think the big risk that Michael Burry sees and a lot of other investors see for that sector is the huge wave of the depreciation that's going to hit these companies with the massive amounts of money that they're spending. So I think that's something to certainly watch, and we're going to follow that closely as we move forward. But, anyway, we look at the market from price to sales, forward PE, the current forward PE of the market is 24 times. I know we've talked about price to book not being as important anymore because of the intangibles on the balance sheet. But even if you take a look at the dividend yield of the S&P 500 is a record low at 1.1%. You take a look at so it doesn't matter what metrics you look at. The Shiller PE ratio, which a lot of people like because it's the rolling 10-year average. I mean, we're sitting at almost 41. Yeah. And go back to the high, December 1999, it was 44. And today we're at close enough to 41. You take a look at the Warren Buffett. I mean, I like this, measurement because it's really easy to understand. You just take all the value of the U.S. stocks and compare it to the size of the U.S. economy, and that ratio, market cap to GDP ratio, is the highest point in history. But does anybody care? Not yet. I like this chart because it's kind of the mentality of investors. Investors have this preconceived notion that the companies that led you in to this prolonged bull market are the same companies that are going to lead you out in the next cycle upwards. Yeah. But the chart clearly says it, like if you look at IBM in 1985 and 1990, and isn't it interesting that, IBM goes from the top right to the very bottom. GE, that's a long run for GE. And we talked a lot about GE at the last podcast that we did. And, then GE basically falls off the map. And then you've got Apple and the Magnificent Seven. And, I think it's hard to say that you can use history as a guide today, but the reality that this chart says is that the companies that are currently leading the market way are probably not the companies that are going to lead the next bull market. So that'll be interesting to follow that chart as well. You take a look at the Magnificent Seven, we're talking about it but the reality is that the magnitude and the dominance that they have in the S&P 500. 21.5 trillion. The Mag 7 represents 35% of the S&P 500. You go back to 2020, it represented 18% of the S&P 500. Mm-hmm. So it's almost doubled in 5 years.
It's concentrated.
Concentrated, and more concentrated. And a lot of it has to do, with the ETFs and all the passive investment. Nobody cares about margin debt. I care about margin debt. I think investors should care about margin debt. As of the end of November 30th, 2025, margin debt was $1.21 trillion. Go back to November 30th of 2024, it was $860 billion. $860 billion to $1.21 trillion. You're really good at math. That's a 300% increase in 1 year. Pretty damn crazy. Mm-hmm. And I always like to say it's painful to lose money. Definitely. But it's excruciatingly painful to lose borrowed money. Yeah. This is what blows my mind, is the growth of double and leveraged ETFs. And, I talked about it last podcast, but just to make sure everybody at home understands. So you either have double or leverage. So if you have a stock, or more like an index, an ETF that tracks an index, if it goes up $5 in a day and you have a double, it's up $10. If it goes up, you have a triple leverage, you made $15. But the reverse is also true. Yeah. If it goes down, you lose $10, you lose $15. And so the growth of these, you've gone from $60 billion, right? $60 billion to $240 billion. That is an astronomical increase. And I said 300% on the last slide. That's a 300%. Yeah. That's a 300% increase.
300% increase. I was wondering.
Yeah, because I could see you doing the math, going, okay, yeah. No. Anyways, that's the 300%
that's massive. And everybody when the market's ripping, you have FOMO on top. People want to shoot for the stars.
Yeah,
and it's becoming gamified at this point.
Yeah, and you just take a look at the record number of leveraged ETFs. We're at 701. Yeah. We were at 200 in 2020. 200.
You got single.
It's now up 225% in 5 years. Yeah. We take a look in Canada. Record number of launch of new ETFs. Record number of inflows of ETFs in both U.S. and in Canada. Yeah. Mind-boggling. In the last third week of December, $145 billion of money into new ETFs in 1 week in the United States, a new record. Yeah. Total amount of money in ETFs in the United States right now, $13 trillion. Wow. Where was it in 2020? $4 trillion. Mm-hmm. $4 trillion to $13 trillion. That's almost 4 times. Yeah. Astronomical. And again, I hate saying it, and I don't like using the word, but I think that's stupid money. No consideration for any valuation metrics whatsoever. Let's just throw it up against the wall. And a lot of investors today that have not seen a prolonged bear market, I think, are in for a rude awakening. So I think this is a really, really interesting chart, because the correlation is incredible. So it charts the inflation rate from 1966 going out all the way to 1983, and then it overlaps 2014 to present. So present is the red and the blue, and you can see exactly where we're at. Mm-hmm. So this is kind of like points to like what could be the catalyst for a prolonged bear market. Well, I mean, I've talked about worldwide debt. The world is awash in debt. Mm-hmm. Nobody seems to care. Maybe that's not the catalyst. How about the geopolitical risk? Yeah, could it intensify any more every single day of our lives?
I know. It's insane.
It's insane.
Yep.
Market's not really concerned about the geopolitical risk. Valuations are stretched off the charts. But what if, hypothetically, what if inflation follows what it did before and hits a double top? When inflation fell from 9.1% in the United States to 2.7%, investors got complacent. They feel a great degree of comfort.
Yeah.
And it gives them an extra round of confidence. But if we see an uptick in inflation, could be tariffs, who knows?
Yep.
That could be very damaging for investors' mentality and their conviction to the stock market, and it could be a catalyst.
Could be. I would say just as a rebuttal to you, there would have to be some sort of massive geopolitical event for you to get a double top. Because to get back to where we were,
we're not going to get back to where we were.
The only reason we had that 2021, 2022 peak level inflation was because of COVID. Supply chains were crippled, and so that was a one-off event. We would have to see
a huge geopolitical shift,
and we're not smart enough to tell you what.
We're not smart enough to tell you, not to suggest that it's going back to the double peak, but I'm just saying if inflation does pick back up again.
If inflation does pick up, it's going to be tough because it's going to force the Fed's hand to not lower rates, and the anticipation of those rate cuts is inevitably going to be washed, and if we don't get any more liquidity, then that is not a good thing for the overall markets.
Yeah, absolutely. So this is an interesting chart to say that, everybody's all in. Investors are all in on stocks, and we take a look at all of the cash levels have dropped at the end of this last year to new record lows of 3.3%. So everybody's all in. All in. Now, this stock chart really tells the story of the stock market and what has prevailed over the last, not just last year, but the year before. And the reality here is we have been in a period for the last 2 years where companies that don't make any money are surging and quality companies are underperforming the market.
Especially last year.
Especially 2025. Yeah. So when Cody does his reviews and you look at it and you look up against the benchmark, you're going to say, well, we underperformed the market. Well, I can tell you we're not the only ones that underperformed the market. There's a lot of portfolio managers there that underperformed the market. And the reason why the underperformance is because the good quality was pale in comparison to the companies with no revenue. What I feel comfortable telling you is that the pendulum is going to switch the other way. And Cody's done a great job to ensure that all of your portfolios have the very best of the best companies in the world today. And the patient investor will get rewarded by sticking to quality. And that quality, I think, and your patience combining those together right around the corner, that we're going to get rewarded in the not too distant future.
Sorry, just you go back to that for a sec. Like you look at the substantial, like I think you need to understand the magnitude of how what this chart is saying. So on the top here you have quality stocks beating the market. So this is when quality is really outperforming. Okay? And then you have when quality is underperforming. This is where we have high levels of speculation. Okay? And this is usually where bubbles form. So the deeper the drawdown of quality stocks underperforming the overall benchmark, obviously the more speculation we have. It's very interesting to note. We have had 2025 was the deepest portion ever on record, basically on this entire chart dating back to 1995, where quality stocks were underperforming the benchmark, and that even outpaced the tech bubble in 2000.
I know, but don't you? I mean, you can draw. I wanted to speed things up, and but you did a much better job of that. But I mean, you take a look at the tech bubble, right?
Yeah,
and going through, and there's, it's
mind-boggling.
Very, very similar. Thanks for doing that. Trying to move that.
It's okay. We'll try and speed it up. We'll try and speed it up here. Yeah.
Last one for me is the periods of strong optimism are not when quality stands out. They are when they are quietly discounted. And we believe that the quality companies that we own today in your portfolio are discounted, but we think the tide is going to turn. Not to be repetitive, but I think we're going to get rewarded in the not too distant future. There you go.
Fantastic, Father. Thank you so much.
You're welcome.
Okay. Great. So for my portion, I want to go through taking Ken. He had a year in review. There was obviously mixed in things about the outlook, some concerns. But what I really want to give you guys is an outlook as we move forward in 2026 on the economy. I'm going to run through it relatively quickly because last podcast, I did a full economic update that was probably way too detailed about inflation, job growth, GDP, all of that. So I'm going to run through it briefly because not much has really changed overall. And then I also want to run through the 2026 market outlook, which I think is the most important piece of the puzzle at this point in time.
Yeah.
Okay. So just going through, Ken's already kind of been through these figures, but if we take a look at where the U.S. economy is right now, I would say firing on all cylinders, up 4.3 for the third quarter 2025. We have consumption, which making up 68% of GDP, up 2.4%. The consumer is doing well. Americans are doing well. Nothing has changed from
what... The stock market has created wealth. Why not spend?
And last luncheon, we talked about this. We said the U.S. consumer is going to continue to be resilient. We only had second quarter data at that point.
Gotta love the luxury handbags.
Exactly. We already touched on this. Inflation in the United States at 2.7. Range bound. I believe it's going to be range bound unless we see that large geopolitical event that could hypothetically cause a second wave of inflation. But I think it's just important. If we do not get that, we're not returning to those peak levels.
Well, I don't think those peak levels.
No, those are far
removed.
But the key point, like I said last luncheon, not to sound like a beaten record by any means, but that era of low inflation sitting around 1.5, 2% are gone.
Yeah.
Right. And I think we're going to be range bounded between that 2 to 3% margin, which in reality, if we look back at actually the 50-year average of inflation over the course of the U.S. history, headline inflation has actually been around 3.6%.
Yeah.
Right? So
I mean, you take out COVID, take out 1982, and, you're right back to flatline.
We're right back kind of in the middle of where it should be. So not an overall big concern. Inflation is under control. U.S. job outlook, payrolls have been soft a little bit, but if we still take a look at the unemployment rate, still sitting at a mere 4.6%, which is still well below the 30-year average at 5.5.
Yeah.
Right? So from a overall employment perspective, U.S. is still extremely strong, and I think will continue to be strong as they make their way through 2026, especially with the immigration policies that are happening in the United States. As much as it can be bad in certain scenarios, it does obviously create a little bit, detracts from the labor supply, which we went through last luncheon.
Yeah.
A little bit maybe too over top of people's heads. But for that reason alone, I think we're going to start to still see the unemployment rate still remain relatively low in the U.S. So overall, if I just put a chart up there just in terms of the specific economic indicator, the current trend, and the implication, to save time here, I'm just going to tell you the moral of the story. The forecast still remains, like I told you last luncheon, resilience in the United States, and I would say low recessionary risk.
Yeah.
Okay. Flip over to Canada, different story. The tale of two economies, which we've just been continuing to talk about. GDP was up thanks to net exports, but the main picture that we want to look at is obviously consumption, flat to negative.
A stark difference.
Tough. And that was what we said at the luncheon too, is we don't see much growth from the consumer standpoint because one factor is the unemployment rate is a lot higher, right? Mm-hmm. But this is one thing that has changed from the last luncheon, is when we were presenting the unemployment rate back in, I believe, we did it in October. And was the inflation or the unemployment print was 7.1.
7.1.
Right? So over the course of that period of time, we've seen over the 3 months a drop to 6.5% unemployment, which is a very large drop, right? And that was taken as obviously beneficial. The market didn't like it too much because that doesn't mean, hey, if the unemployment rate's dropping, we're going to get fewer rate cuts. But good for the economy overall. But I wouldn't, if the outlook is looking forward, I wouldn't go as far to say, is this the trend downward for Canadian unemployment? Because if history is any guide, we look back to what could hypothetically be previous instances where we saw such a large drop in unemployment over such a short period of time, 3 months. You have to, and outside of COVID, you have to go back to 2005 and 1997. Mm-hmm. Those two periods, we did see a substantial similar drop in Canadian unemployment. But the funny thing about that is immediately preceding that drop, they were revised upwards basically 0.3% afterwards. So I don't think this is a trend within itself. I feel like we are going to, if history is that guide, I feel like we are going to get a little bit of a lift back up to the unemployment rate, maybe reaching high sixes. But that is all dependent, as I've said before, on what is also the policy of our prime minister. Trump has ICE. Oh. I know we can talk about that,
let's not talk about Minnesota.
Yeah, I know we're going to try not to get political here. But the funny thing is, Trump can do his thing and get absolutely smashed by all sides, saying, "What are you doing?" And I agree, some of those things are completely unacceptable. But the thing is, the funny thing that I find is, if a liberal prime minister does it, Mark Carney, behind the scenes, nobody has a problem. But secretly behind the scenes... But it doesn't get the front page news. No, it doesn't get the front page news. So, like, we take a look, behind the scenes, Canada is deporting 400 people per week. Literally one of the fastest paces in over a decade. Mm-hmm. So,
But that's never in the news.
This is CBC. It was probably tucked in the back, to be honest with you, as CBC does.
Yeah.
But regardless or not, a lot of that, the employment situation, looking at the labor force, immigration is a large portion of that calculation.
Yeah.
Right? And so policy acts, for better or for worse, have major implications. So it's something that we obviously look at moving forward as to how are these policy shifts really impacting the overall labor market. But same thing, if I have to give you an outlook on the Canadian market, you can take a read through those specific indicators. One thing that I did not talk about is, I think key too, and people have been talking about it for quite some time, but I would say now is the biggest point, is I think mortgage renewals. Because if you think about the vintage of mortgage renewals, right? 2026 comes along. Most people usually choose around 5-year fixed mortgages. Go back 5 years. What year is that? 2021.
Yeah.
And what was rock bottom rates? 2021. Right? So rock bottom rates in 2021 when people were able to lock into mortgages at literally
2.5.
Oh, less than 2.5%. Your mortgage rate was like 1.4.
No, I thought mine was like
1.69 was.
What,
Yeah.
1.6?
No, it was low. Yours was lower than that. It was like 1.4.
I knew it was low, but
Yeah, that's 2021 vintage, my friend. Yeah.
God.
Yeah, so low. But regardless or not, the moral of the story becomes is those people that locked in.
No wonder I took out a mortgage.
Yeah, of course. It's free. It was free money at that point.
I remember telling you it was free money.
Yeah, but the whole purpose of that, too, was a lot of people got, I would say, this is a completely side point, but it just speaks to the banking industry and why people hate banks sometimes and you don't get the best advice, is people that were literally buying homes in 2021. The banks were pushing variable rate mortgages at a point in time when you had fixed rates at the rock bottom.
Yeah.
Right? And so I felt bad. I've had some younger clients go into fixed rate or variable rate mortgages at rock bottom. But long story short is those vintages are coming due. I think it's going to put a little bit of strain on the economy. And the forecast, to be honest with you, in Canada, it's not as great as the U.S. Okay, we have slower momentum, fading momentum, and I think that there technically still is at this juncture, especially with a lot of Canada being, there's a lot of politics obviously going on. There is still moderate recession risk in Canada, and my viewpoint from the previous luncheon has not changed in that regard. Okay, but so that's the end of the economic section, and I didn't want to spend too much time on it because I think a lot of what is transpiring today and what could inevitably actually affect the economy is the stock market itself. And I'm going to get to why that is in a second, but I want to provide to you just a quick market outlook. I want to dive for 2026. I want to dive into some of, I would say, the 4 key risks that we see, but also kind of the 4 key drivers as well. Okay, so just quick reflection. Don't need to go through this. All you need to know, all-time highs across the entire board. S&P 500, TSX 60. We're up across the board, all-time highs. Reason for U.S. equity performance, low-quality rally. Ken's been through these slides already. It was a very low-quality rally in the United States. That's what prompted it up to where we are today. Flip over to the Toronto Stock Exchange. Toronto Stock Exchange, all-time highs, 2025. Amazing year on the TSX. Amazing year on the TSX.
Thanks.
But it was not just like we had the low-quality rally in the
silver.
Gold. Yeah, exactly. Like we had the low-quality rally on the United States, Canada was very concentrated in terms of where the actual gains came from for the year. So if we take a look at the left-hand side, which shows you the sector contribution rate of return for the overall TSX, which was up 28% for the year, you add materials and financials, that was literally 73% of the rate of return in 2 sectors. Okay. Another stat, if we just want to take it even further, banks, gold miners, and Shopify, 2/3 of the rate of return. Very, very narrow leadership. And especially when you have gold and silver rally the way that they did. And that's a whole other discussion about why they're rallying and whether it's justified. I don't think a repeat is nearly possible at this point in time, but I still think there could be some gains with the geopolitical uncertainty, the debt problem. I understand the theses behind that investment vehicle. But you take a look at where gold stocks are, and we chart what is the weight of gold stocks on the S&P TSX 60, right? Dating back all the way to 1975. Gold stocks are at an all-time high in terms of their overall share of the Canadian market. Mm-hmm. But you can see from this chart, as with all commodities.
What about that? What about that?
Commodities are volatile. They need to be traded. They need to be traded.
Need to be traded.
Okay. So, key thing, that is the TSX return. Quick overview on markets. I don't want to leave it at that. We kind of understand the story. Going to be giving clients all calls to go through the performance. So I really want to focus next on what I believe are some of the downside risks, right? And so as you approach all-time highs, I think the key question you have to ask yourself is, when optimism's up there, we're seeing stock prices where they are today, you start have to asking a question, what could go wrong? And unfortunately, there's a lot of things today that could hypothetically go wrong. But what I wanted to do is list what I believe are the top 4, I would say, downside risks for 2026. Number 1, valuation and concentration. Number 2, the AI bubble, as some will believe it, and what we call the metaverse moment. U.S. power generation constraints, and also geopolitical events. So I'm going to go through these one by one. I don't need to go through the first one that much because I feel like we've beaten this thing to death at length. Valuations are elevated. Concentration is immense. Both these slides show it. We don't need to beat a dead horse per se. But valuations, just a little rebuttal to that. Valuation, you cannot solely focus on valuations. Valuations are a piece of the underlying puzzle. You need to look at a lot of different aspects beyond just the valuations to make an actual investment case. But that being said, valuations and concentration still a concern. The one thing, and we're going to spend the next, I would say, 10 minutes really talking about AI. AI and the entire generative segment is, at this point in time, the only thing carrying the entire market.
100%.
AI has the market on its back. And it is, I would say, the single most important aspect as we head into 2026. And so with the significant run of NVIDIA, the significant run of a lot of individual IA, a lot of obviously alternative artificial intelligence plays over the last little bit, it's important to understand kind of how we got here and obviously the repercussions. But one thing is for certain. The amount of money that companies are spending on AI is ridiculous.
Staggering.
Since the fourth quarter of 2022, Meta, Microsoft, Amazon, and Google have spent a combined $1.3 trillion. Let me say that figure one more time. $1.3 trillion on CapEx and research and development. Basically all of it related to AI. Astronomical. And this chart, I just like to put it up there to put it into perspective for how large this actually really is. Because sometimes people can't quantify 1.3 trillion. So let's just put it.
How you combine them on the far right.
Let's actually show you how big this thing is. So if we go back to the 1930s, and so what this shows is we have essentially a specific type of major project, and that spend on that project a percentage of U.S. GDP. Okay, so 1930s we have the Hoover Dam, the Golden Gate Bridge, we have Midtown Tunnel, LaGuardia Airport, a little small there. 1944 Manhattan Project, 1949 electricity. We have the Apollo Project, Interstate Highway, and then the entire Broadcom exposure in the tech, internet boom. We stack all of those together, and we look at just 2025.
That's mind-boggling.
Tech CapEx spend, just a little bit lower. Astronomical in terms of the spend, right? And so when you're spending this amount of money, and especially with Mark Zuckerberg, and you said this last podcast coming out on September 9th, 15th, he went on his own podcast or not his own podcast, someone else's podcast, and said that they're planning to spend $650 billion. But the funny part is, it says we may miss spending a couple $100 billion, but the risk is higher on the other side. So the concern becomes from an AI perspective is if you are pouring large amounts of capital into a project, you better expect it, and investors expect it to return money and profits. Because if it does not, well, then guess what? We see an exact repeat of what we call the metaverse example. Facebook, before it was rebranded as Meta, and Mark Zuckerberg decided to pour
what happened
billions.
What happened to your goggles, by the way,
and
your that you were wearing, and your dream car, and living in that beautiful house of yours?
It's gone.
Infinity pool and all of that.
But at that point in time, Zuckerberg pouring billions and billions of dollars into the metaverse for none of it to actually pan out. And when you pour CapEx and investments that do not generate returns, guess what? Your share price suffers substantially, down 72%. So, long story short, money's been poured in. Is the return there is the main question. That is the $1 trillion question. But a risk. And talking about, and it's just all about the disruption, I would say, of AI, like the main theme, as I've said before, is AI is carrying everything on its back. If we're looking for deterrence, what is going to throw this AI theme off track, another risk would be U.S. power generation constraints. So I'm going to keep this very brief because I read papers and papers about this. But overall, just put very simply, to power a small city, that is equivalent to powering one data center. AI uses a tremendous amount of electricity, a tremendous amount. And with the forecast moving forward as to the growth of AI moving forward, the U.S., and I would say, except for China, we don't have the energy. Infrastructure built.
Yeah.
They're trying to build it, but it still takes a long time to build a nuclear plant. It takes a long time to build those things. And on top of that, also, the chips themselves are made to be energy efficient, to use less energy as a whole. But what we're seeing is the energy efficiency gains from these chips is dying dramatically to where they're kind of tapped out. Chips are going to use the energy that they use.
Yeah.
And so we're at a problem to where if we can't build the infrastructure necessary and the energy to support AI, and the demand is actually real, but you don't have the energy to support it, that's a risk to AI within itself, which I think is not really talked about, but is still, I would say, a grave concern for the individuals. The individuals that are actually building out the infrastructure. And last big risk that is completely unknown, but is quite scary for obviously a lot of people, like waking up on January 2nd to the news on my phone that Maduro, Venezuela, I saw literally the video.
Yeah, just going and pluck him in the middle of the night. Boom.
Yeah, I know.
Yeah.
In his PJs with the glasses.
Yeah.
It's crazy.
Wife's gone too.
But there are and then today, U.S. seizes a Russian flag oil tanker.
Two of them,
yeah. So the list is endless. We're not geopolitical risk analysts.
Yeah.
We're fundamental risk managers. We look at fundamentals of companies.
Trump obviously doesn't figure Greenland's part of NATO. So, whatever's going to unfold there, this is craziness.
And we're not here to say what is going to be the catalyst or what could hypothetically unfold, because nobody knows. It's just a guessing game. But one risk that I would say, if we're still back on this AI train, which I think is, again, the biggest thing that we need to be concerned about, is if China really wanted to retaliate against the U.S. and every single one of its Western adversaries, per se, it would do something with Taiwan.
Well, you saw.
We've seen
the fire show.
It's been going
over
it's been
Taiwan,
going on,
landing in the waters around Taiwan.
It's been going on for a while, right?
Yeah.
There's military drills left, right, and center all the way around Taiwan. But why it's important to the AI story, which some clients may not understand, but there's a company in Taiwan which is called Taiwanese Semiconductor Manufacturing Company, TSMC. Okay? TSMC is basically a monopoly. Every single semiconductor that is put in your phone, laptop, fridge, computer, car, any little electronic comes from them. So, and by the way, we do own it.
Thanks for the disclosure, Cody. Yeah.
I do own the stock.
This is CNBC, by the way. So.
Exactly. Yeah, I do. We do own the position. And it was actually, since we made, I think it's just side point here, but ever since we made the shift to our new investment framework for U.S. focused growth and for U.S. international growth, getting rid of Poland and introducing the sophisticated approach of having multi-managers on top of our own quantitative research, I think it's a good point to add here, which is when we flipped over the international growth mandate just before the tariffs unfolded, it allowed us to take advantage of an opportunity that I don't think Poland would have necessarily taken advantage of. So TMC was down at that point close to 25%. It was a position that we saw being severely beaten down. We added it to the portfolio at that point in time, and now it is up 76%. Okay.
Well done, Cody.
There we go.
Well done.
Just a side point.
Well done.
Okay.
I told you to get rid of
regardless or not, TSMC controls all the semiconductors, and if China really wanted to screw the rest of the world, yeah. And that within itself, you blockade Taiwan, you do whatever you want with Taiwan, you restrict semis coming everywhere, AI cycle killed, and everything is crippled. Tough.
Huge risk.
Okay. But and so now let's flip to a more positive. standpoint.
Let's get.
It's the new year. Okay.
Let's get some optimism going here.
Yeah, we need some optimism.
Yeah.
Okay, because you know what, to be an investor, I've said this before. You have to be a realist. Okay. You can be an optimist, but at some point in time, optimism leads to greed, and you get caught going the wrong way. You can't be a pessimist the entire time because you'll never make money and inflation will take care of you. So you need to be a realist, and in terms of being a realist, you have to ask what could go wrong at market highs, but you also have to understand what the hypothetical drivers could be to propel this thing moving forward. And so I think there are a decent amount of drivers moving forward. Listing them here, I'm going to go through them one by one, but we have the wealth effect, monetary easing, the fiscal engine, and the AI supercycle. So just to start with the wealth effect, okay? So the wealth effect is a phenomenon which essentially says that as the wealthier get wealthy and stock prices get higher, that leads to increased confidence. The wealthier you become, the more confident you become, and thus it allows you to spend more. Okay? So, and that is a key aspect, because if we take a look at the net worth growth in the United States, this is the left-hand side now, of the top 20% in blue, and then the bottom 80% in gray. Starting from the fourth quarter of 2019 at even levels, the top 20% have grown their net worth to 41 trillion, while the bottom 80 only at 16 trillion. Okay?
The wealth effect.
As much as that may, and not here to have conversations about, obviously, whether that's good long-term speaking from an economic perspective about the wealth divide per se, but as a catalyst moving forward, if we continue to see stocks elevated and wealthy people continuing to spend, why it is a catalyst is because the right-hand side is if we look at the top 20% of wealthy people, they make up 38% of the overall spending in the United States of America. That's massive.
Have you seen the sale on private jets? Have you seen the sales like in hotels?
Yeah.
Where they're like no longer, they will take out an entire section of the hotel.
Yeah.
It's just,
It's
it's mind-boggling the amount of money that is being spent by this cohort.
Literally, the top 40% make up over 50% of the entire spend, right? So it's that effect which could propel moving forward if stock prices continue where they are, right? And this is also interesting to know, which goes into the wealth effect too, is the change, and this shows you how massive the equity run has been, but this is the change in the consumption or the composition of household wealth in the United States. And we have two main lines. The blue line represents the proportion of your wealth to real estate, your home, and the beige line represents the proportion of wealth to equities. For a very long period of time, the house was the main thing, right?
It was.
But now, as we move forward, we look where we are today. Equities are now close to 35% of the United States household balance sheet. And so the wealth effect can, and this is a rebuttal to, even though it can lead to higher GDP, the wealth effect is also, can work the opposite way. And this is why I think I don't worry too much about the U.S. economy itself. I worry about the stock market because of the aspect that with a balance sheet that is now leveraged to volatile equity and not relatively stable real asset prices, if we were to see a significant correction and a prolonged correction,
prolonged.
to where you see a 30 to 40% prolonged correction on that household balance sheet, and that drops off a cliff, even the top 20 are going to feel it.
There goes that private jet.
There goes the vacation.
Hopefully I leased it rather than bought it.
Deterred consumption comes back in, right? And that becomes the overall catalyst to where you don't need to wait for consumer spending to drop off a cliff. You need to wait for the equity markets to drop off a cliff to then actually have consumers start questioning, well, maybe I'm not as wealthy as I once thought. Maybe I should put the brakes on a little bit and deter a little bit of consumption. That's inevitably where I think you're going to see consumption actually come off because of an actual stock market correction. The stock market is going to lead to those economic repercussions. So as much as it can be a catalyst moving forward, if stock prices continue, it can also work the opposite way around. And this is why there's always flip sides to the coins, but a very interesting dynamic. Second catalyst, which is just very simple to understand. We are in an easing cycle in the United States. If we get the rate cuts that we are, lower interest rates promote borrowing, promote economic growth. They are good for real assets. That is a tailwind, and it is happening. It is a substantial tailwind.
It's going to happen.
So don't fight the Fed, as they say.
Especially the new Fed guy.
And even, and this is the thing, is people can say, well, we're doing monetary easing at the late end of a cycle. Well, if you look back at previous cycles, even if you have monetary easing late stage in a cycle, it's still expansionary in nature.
Yeah.
Okay. So monetary easing, huge tailwind. Another huge tailwind is there's a massive fiscal engine in the United States specifically, but also globally. Okay. So in the United States specifically, the one big beautiful bill, largest tax cuts, both on an individual level and corporate level ever. And it's not just for the wealthy, it is for the middle class, which is extremely, extremely big tailwind for consumer spending. Middle class gets money in their pockets, top class gets money in their pockets. We see how spending has correlated to that. But then we also flip to the spending and the government deficits.
Nobody wants to talk about that.
But still, as you run a deficit and you spend money on projects, that is expansionary in nature. That is expansionary. So from this, if we look at the government budget balances and the rates for 2026, every single country, Canada, US, Germany, Japan, Asia Pacific, China, they're all running deficits. And this is a telltale sign of they're not fighting anything. They're still very much in expansionary mode and promoting this thing.
Print money.
Yeah. And the flip side rebuttal to this is those are deficits. The debt's at, what is it now? The debt clock. I don't even want to look at the debt clock.
I think mine blew up on my computer. Like I seriously think
the computer just
like you used to have it on the website.
Yeah,
Remember
the
debt clock?
Yeah.
Yeah, it's like
It's gone.
it's gone. It's like you know.
Yeah, debt. I think debt will matter at some point in time, but the key question.
I might be dead by that time.
You know Ed Yarndy, right?
Yeah.
Yeah. Okay. So they were having discussions, and I was listening to a podcast about essentially when he was back in the 80s, right? And U.S. debt at that point was $500 billion, right? And everybody was concerned about U.S. debt being that high, right? And Ed Yarndy was the person that coined the term bond vigilante.
Yeah.
Yeah. But he made a key point, which was as much as the debt may be a problem at some point in time, nobody's going to know when. Is it going to stop me from investing today? Because if it stopped you from investing in the 80s when it was $500 billion, well, guess what? It's now at $3 trillion. Nobody cares, and the S&P 500 is where it is today.
Yeah.
Right? So that is why I think, it's still a concern, but it's not stopping us from investing today, and that is still very much expansionary. Okay, last thing that we have to spend a little bit of time on, because I still think this is the key point, which is, as much as I can say the risk is valuations in the AI bubble, okay, and the metaverse moment, it could also be the flip side. It could. This could be the AI super cycle. Okay? And if we take a look, and the first benefit of hypothetically an AI super cycle is the capital expenditures on GDP. The tech sector, CapEx, has contributed 40 to 45% of US GDP growth over the last 3 years.
3 quarters.
Over the last 3 quarters.
Yeah.
3 quarters.
Yeah.
Okay? That is substantial, right? As a promotion to growth, the GDP of the US, on top of obviously a strong consumer. And we can still see that CapEx is continuing to move forward, right? So that is very much, I would say, a very big benefit from if this AI supercycle continues and the spending continues and it's justified, that expenditure is going to increase GDP, okay? But what also is important to understand is when you are spending capital, it's important to look at how you're financing that capital, number one, okay? Because in the dot-com bubble, and we're going to have a lot of relations because everybody's talking about the AI bubble being the new dot-com, right? In the dot-com bubble, majority of CapEx expansion was done by debt. You take a look at the left-hand side of the screen here today, besides a couple outliers. You look at net debt to EBITDA, which is revenue. 0 indicates that they have excess cash over short and long-term debt. Look at all the names there. Google, NVIDIA, AMD, Apple, Adobe, Salesforce. 0. Not being funded by debt. Different than the tech bubble. Very good. It is being funded, key point, it's not being funded by debt. It's being funded by the free cash flow of those businesses, which is very different.
Massive.
So if you take a look at the free cash flow revenue, so free cash flow, just simple explanation, revenues minus your operating expenses and also your capital expenditures, okay? The free cash flow of a lot of these direct AI stocks is ridiculous. Ridiculous. Look at NVIDIA's free cash flow, 45%.
So they can go buy companies for $20 billion, like right, left, and center.
But a lot, except for a couple outliers, free cash flow is dominant. And that is the quality of the fundamentals. Okay?
Very different picture than the tech bubble.
And I think what's also important too is you can talk about the discrepancy between the Mag 7 and the other 493 per se, in terms of their valuation, the Mag 7 having the concentration that it does. Well, I'm going to tell you one thing for certain. The reason why the Mag 7 has the concentration and the market share it does in the United States today is because it is the only thing growing its earnings per share in the United States. You take a look at this chart. The earnings growth. Earnings growth, in my opinion, over the long term, if we're taking a 10-year viewpoint, the only predictive power of a stock price increasing is earnings growth. There is no earnings growth, in my opinion, outside, if you look at the 493 in blue, earnings growth over the period of time versus the Mag 7, pales in comparison. If you want earnings growth, why would you buy 493? Okay? So, again, quality of earnings growth. So, also, why I want to say it's different than the tech bubble, and I keep saying that, and I know it's your famous quote, it's this time is different, or the most dangerous words in the English language.
Yeah, fine.
Right?
This time is different.
But if we look at tech valuations, and we just, instead of just looking valuations across the board on the S&P 500, let's narrow it to tech. You look at 2000 versus today, tech valuations, both trailing and forward, are half. Okay? Another huge problem that was in the tech bubble was what I like to call the yucks, okay, which are young, unprofitable companies.
Yet 64% of the companies were non-profitable.
So you had young companies that just IPO'd, they had negative cash flows, but they represented a very large portion of the overall index during the tech bubble, almost close to 10%. You look today, it's at 1.5, and what's interesting to note is I'm glad that 2021 happened because it did get a little bit of the froth. There were some yucks in 2021, but they did get annihilated and a lot of them went bankrupt.
This is bringing back a lot of memories. Like, our good old buddy Nick Magendy and I, our best years in the business were 1999, 2000, and 2001 because Nick and I didn't understand a thing about technology. And we had three of the greatest banner years. We did double digits in all of those years, if you go back and look at it. So, Nick, thank you for that.
Yeah. Okay, so, again, I think very, very much different. But you still need, with this AI super cycle to continue and to pour the amount of dollars in, you just need to ask the one key question that investors are asking: what's the revenue? What are the profits? But the first question you really need to ask is, there's going to be profits, there has to be adoption. Companies need to adopt it. And the data is too early to answer these two questions because we only really have surveys. But the way a company is going to adopt AI, plain and simple, it decrease costs and it increase revenue. Okay? And from a Harvard survey where we look at 2,800 respondents, the results are they're okay. They're okay. A little bit of adoption. We see a little bit of an increase in revenue, a little bit of cost production, but still very much unknown. And if that's unknown, the key question becomes, what does the profitability look like? And no company at this point in time, we can really see what the revenue is really going to look like. Microsoft is actually the only company within its financial statements. I know nobody's looking at financial statements, which actually breaks down their AI as a separate line item. But it is too early to tell what the profit is going to be. And that is the $1 million question as to what it's going to be. Okay? So, long story short, if I have to sum all this up, we got the downside risks we've been through, the upside risk, some of them ebb and flow together. But overall, what our positioning is for the remainder of the year, for 2026, is it's going to be very neutral. We have downside risks that are prevalent, but we have a lot of upside drivers, right? And so the key thing here becomes is if we have a neutral stance where I don't think anybody's going to tell you what's going to happen geopolitically, what's going to happen with those 2 questions about AI, if anybody was smart enough to tell you those questions, they'd be a billion. But what I do know is that relying on our strategic asset allocation that we have in place and owning quality names, especially them being discounted, is going this year, if quality reverts itself and having the underlying quality that we do within our names, regardless of what transpires, I think quality, if we do have a good year, quality is going to outperform. If we do see a correction, which we might, quality is going to go down less. So I think this year is about maintaining a level head, okay? Looking for the opportunities that present themselves, still being proactive, but still maintaining a neutral stance until some things tell us one way or the other, okay? Yep. And that's how we intend to position, and it's not really significant changes from where we are today. We were defensive in the beginning of 2025. That stance, as equity markets have advanced, have taken us really pretty much to a neutral standpoint. So I would say there's not many changes, but be rest assured, if there is anything that does transpire, we will be very proactive in terms of what's going on.
Absolutely.
Okay? So just quickly, we like to end with what is beyond the noise, okay? And so just a lesson. We've talked about all the noise. I've probably overwhelmed you. It's been a long podcast already. But one thing is for certain. At some point in time this year, the equity market is going to correct.
Come on, that's what I said last year.
I know. Yeah.
And I only got it for 5 days.
But if you take a look at this chart, this goes all the way back out of 41 years, dating back to 1985. What this shows you, the gray bars represent the final rate of return of the Toronto Stock Exchange in a given year. Okay? The red bars represent the maximum drawdown. Okay? At any given point. What's interesting to note, and that maximum drawdown, on average, has been around 14%. So, if we had an average year, you can expect at some point in time, the Toronto Stock Exchange is going to drop 15%. But what's interesting to note is if we look at this, 30 out of the 41 years have been positive, 73% of the time. And also, every single gray bar, the final return, has always, obviously, been higher than the drawdown. Okay? So, regardless if it becomes good year or a bad year, there's going to be volatility, and there is going to be a drawdown at some point in time. And so expect declines. But if you expect declines, you got to make sure you have insurance. Okay?
Yeah.
And the insurance are our asset allocation, our bonds, and our alternatives, and our cash. Okay? Because I like to just, some clients might not understand it just from a financial literacy standpoint, but simple explanation, right? Is if you take a look and you relate having bonds as insurance. You can think of home insurance, car insurance, right? So if you go through, you pay for insurance at the beginning of the year, you go through the year, nothing's happened. You haven't gotten in a car accident, your house hasn't burned down, nothing's been stolen. Okay? Good.
You don't live in Vancouver if nothing's been sold.
Sucks that you paid the insurance. But guess what? It is what it is. That's the same thing as the equity markets performing 20% and you owning bonds. Well, I had the insurance. But if you have a bad year, crash your car, your house burns down, your house floods, aren't you glad you had that insurance? That's what bonds do. That's what bonds do. And if we do have a bad year, which we most certainly might, showing you all the risks, the one thing is for certain, we have that insurance in place. And that is the crucial element moving forward and what you should focus on. Alrighty, last things. Quickly, performance reports coming out. I'm going to be calling every single one of you to go through a performance review, an update, and anything that you want to dive into here further, be more than happy to go through it. Wealth notes are going to come out. Again, be very detailed. If you want to go through anything, be more than happy to answer the questions. Okay? So, I know that was long. Very long.
Yeah, you must be tired.
If you have
and
you have made it this far, we do sincerely appreciate it. But in all honesty, like as you've seen, there's a lot to get through. There's a lot of moving parts. As much as it may have been long, we want to make sure that you're obviously informed. But we do very much sincerely appreciate, obviously, the trust, the ongoing confidence in our entire team.
Yeah, and
thank you, Ken, for coming into town to do this.
Thank you for taking the time to listen. And, despite all of this, the most important thing as we all get older together is our health. So, cheers to a very, healthy and, good 2026. And let's just all stay healthy. So all the very best to all of you.
Thanks, guys.
Thank you.